Black retirees and pre-retirees concerned about income taxes in retirement. You want to know how to manage your income tax exposure in retirement. How do you reduce your income taxes? This presentation is for you. We're going to be talking about income taxes in retirement, more specifically, how to minimize your income taxes on your retirement income benefits. First thing we're going to talk about is how much you should have saved at your current age. Very important. That's where we want to start. We want to know if you're even on track based on your age before we have a conversation about income taxes. Also, this is not going to tell you where the money should be, right? This is only telling you how much you should have in assets, but it's not telling you where those assets should be. The second thing we're going to talk about are the four buckets where you have assets, where you can actually have your retirement assets. Okay. So, again, how much you should have based on your age. And secondly, the four buckets descriptive of where those retirement assets usually are. And then third bullet point, we're going to talk about the difference between tax planning and tax preparation. We're going to briefly discuss upcoming tax changes that you need to be aware of, how income impacts healthcare costs. Very important. You can't really have a conversation about retirement income taxes without discussing healthcare, because as your income increases, so too does the cost of your health care. We're going to talk about that interplay between income taxes, income, and health care costs. We're also going to talk about stealth taxes, okay? And those are going to be the IRMA, the NIT, and the widow tax. We're going to do a deeper dive into the widow tax. We're also going to discuss the impact of Social Security on your income taxes and the tax implications of receiving an inheritance. That's important as well, because as you get older, you will have family members that pass away. You're going to be left with real estate, retirement accounts, investment accounts, and you want to know in advance, how is that going to impact what I'm paying for my health care, right? You don't really think about that a lot of times, but once you get that big chunk of money, or once you sell that asset, once you sell that property, all of a sudden you realize, oh damn, I'm paying all these extra taxes. Where if you had engaged in tax planning, which we're going to talk about today, you could have at least had the possibility of minimizing or potentially eliminating some of those taxes that you would pay otherwise. Okay. So the first thing you know, there is no boilerplate solution. There's no one size fits all. Every individual situation is going to be different. So don't take what I'm saying to be gospel for your individual situation. I always recommend that you sit down and have a well thought out, a deeply involved discussion with a financial planner that can help you map out your retirement income. This is about helping you create a retirement income plan that is tax efficient. A tax efficient retirement income plan is very important, because it doesn't matter how much retirement income you receive. What matters is how much of that money you can actually live off of. And that is why tax planning is so vitally important. All right. How much should you have saved at your current age? I have a chart here that is a rule of thumb chart that helps you see where you should be right now based on your current age. If you're a 60-year-old and you make $100,000 a year, you should have $1 million saved. Now, this does not tell you where the $1 million should be. Okay, right? It doesn't have to be all in liquid, like investable assets. It could be property, right? So this is not where the money should be. This is telling you how much assets you should have, either income producing, growing assets that can be used to support you in retirement. Okay, so again, on the screen here, you see that that number is a function of your age and your salary. Okay, so the older you are, the more you should have saved, which you already know that. Now we're going to talk about the four types of money. So this answers the question, where is that money? So we talked about on this slide how much you should have in retirement assets. On this slide, we're going to talk about where those assets usually are. Okay, so these are the four buckets. You want to call them retirement asset buckets. First bullet point is what is known as a taxable bucket or a taxable account. This is any and all money that you have saved for retirement that is outside of your retirement plan. This includes things like your brokerage account, real estate. If your real estate is not held inside of an IRA account, you have rental property that you acquired over the years, apartment buildings, any assets that you have that require you to pay a tax bill, either in the current year or in future years, based on maybe money that you're earning from the property. Maybe you have stock that you've purchased in several companies. That money may not be in a retirement account. It just might be in a Charles Schwab brokerage account or E-Trade brokerage account or Interactive brokerage account. And you've been basically managing that money on your own. But here's the deal. That money is in a taxable account, meaning that as you make money on that account, you will incur a tax liability. If it's stock, you're going to have a tax liability when you sell that stock. If it's rental property, you're going to have a tax liability when you sell that rental property, unless it is in a either tax-free account or tax-preferred account. Now, second type of account is known as a tax-free account. Two examples are your Roth IRA account. Your Roth IRA is tax-free as long as you satisfy the 5-year look-back rule. All of the money, all of the growth in that account is tax-free. You can also use life insurance as a tax-free account. If you want to learn more about using life insurance as an investment, I would encourage you to check out one of my videos. I have a couple of videos on my YouTube channel where we talk about using a properly structured life insurance policy as a retirement investment vehicle. Today's presentation is going to highlight the importance of tax planning, of not only financial diversification. We know about financial diversification, but we also want to have tax diversification as well, because that will ultimately impact how much of your retirement money you can actually live off of. So tax-free accounts, again, Roth IRA, life insurance are examples. Third account is what's called a tax-deferred account. This is your retirement money. This is your pre-tax retirement account. You are probably, if you're working right now, you're putting money into this 401k, 403b, TSP if you work for the federal government. All of the growth in that account is tax deferred, meaning you do not pay taxes on any of the growth in that account until you take it out. That is tax deferred, meaning the taxes will be paid at some point in the future. That's different than a taxable account, where the taxes are going to be paid in the year subsequent to the taxable event. Okay, so tax deferred account or a tax deferred account is what most of you have, and that's where most of you are going to be pulling the lion's share. Besides Social Security, you're going to be pulling the lion's share of your money out of the tax deferred bucket. Again, IRA, 401k, 403b, TSP are examples. And then what's called a tax preferred account. That's your Social Security. The reason why it is tax preferred and not tax free is because it's not tax free. Social Security is only tax free if you make less than $34,000 a year in total income. When your income exceeds that threshold, your Social Security then becomes taxable. Okay, it's taxable at different percentages based depending on how far above that $34,000 number you are. You all know the more you make, more likely your Social Security is going to be taxed. So again, these are the four buckets or the four places where you're going to likely have your retirement money. So what we want to think about now we understand what we need to have saved, right? We just talked about that. I'll go back. We know what we need to have saved based on our age, which is a function of our age and our salary. We also know the four buckets, which basically are where we could have that retirement money. Again, taxable, tax-free, tax-preferred, or tax-preferred. So this is where your retirement money is. Okay? Now, let's talk about tax planning and the impact or the importance of tax planning on your retirement income plan. The way you want to think about tax planning is a proactive process that you engage in today, wherein you're forecasting your income tax liability in the future and you're making the necessary adjustments today to minimize the impact of future income taxes on your future income. Tax planning is proactive. You're looking into the future. You're forecasting into the future. You're planning for something that is ultimately going to happen in the future, but you're doing that today. Many Black retirees, Black investors do not engage in proactive tax planning. We do tax preparation, right? You go to H&R Block, okay, or even if you go to an accountant, just because you have an accountant does not mean that you are engaging in tax planning. The accountant that does your income taxes and does what you tell them to do, or the tax preparer that you're using to do your income taxes, those people are engaging in reactive tax planning, meaning they're essentially responding to something that's already happened. They're already basically they're responding to what's already occurred in your income tax situation. They're not helping you plan for future income taxes. And this is again the difference between tax planning and tax preparation. Make sure you are engaging in proactive tax planning prior to retirement so that you can have more of your income, keep more of your income in retirement. Okay? Now, the thing you want to know about is some tax changes that are going to be happening. Okay, now you all know, some of you, most of you know about the Jobs Act that was passed under the Trump administration. The Jobs Act under the Trump administration did a couple of things. It raised the standard deduction. It also reduced the amount of income tax at every bracket, okay? And it basically allows individuals to keep more of their money, right? It was passed in signing the law December 22nd, 2017, okay? But what you also need to know is that this tax break is going away. So what that means is that the end of actually I said 2026, it should be the end of 2025, okay? December 31 of 2025 is when the Trump tax cuts under the Jobs Act expire, which means that these tax brackets that you see here are going to go back to where they were prior to that December 2017 tax law being signed into effect. So all the taxes are going to go back to where they were. What does that mean for you as a retiree or pre-retiree? You're going to pay even more than what you're paying right now. If you're already retired, you're going to pay more than what you're paying right now. Okay? If you are yet to retire and you are watching this because you are concerned about future income taxes, you want to prepare for income taxes, do what you can to reduce your income taxes, this is important for you because now you know the writing is on the wall. You know exactly what is going to happen unless the federal government signs a new tax law into effect, which they could very well do. But you don't want to hang your hat on that. You want to engage in tax planning because tax rates are going to increase after 2025. They're going to go right back to where they were. So again, without having a tax plan in place, okay, you're going to give up more of your money than you have to give up. Okay, so again, Trump tax cuts expire December 31 of 2025. Okay, now let's talk about stealth taxes. Now, this is slightly different than income taxes in the sense that stealth taxes only apply if your income reaches a certain threshold. So if you never reach a certain threshold with your income, then you're not going to ever know anything about these taxes. There are some retirees, they'll never even see these taxes because they'll never make enough, right, from all of their sources to even reach the minimum threshold. But for some of you who have investment property, you have pensions, you getting Social Security, you may even be working part-time. You have 3, 4, 5 different income streams coming in. So guess what? Now you're basically every dollar you make is pushing you into a different tax bracket. And what that means is you're now going to be subject to additional income taxes or additional taxes, what is known as stealth taxes. So let's talk about what these stealth taxes are. First bullet point is what is known as an IRMA tax. Okay, this is an adjustment that is made to the amount that you're going to be charged for your Part B and or D premium when you are on Medicare. So this is only going to apply for those of you who are on Medicare, okay, or when you are on Medicare, for example, and your income exceeds the numbers that are on the screen. You're going to pay more for your Medicare coverage. So they're going to charge you more for your Part B premium, for example, which I think is $164. That's your Part B premium. If you don't have any subsidies, which you can actually apply for, we'll talk about that later on today. But if you are making $60,000, $70,000 a year, okay, you're not going to ever see this, okay? But if you got multiple streams of income, multiple sources of income, and you are on Medicare, that Part B premium is going to be more than $164, and it goes up as your income increases. So this is what I was saying before. This is what I meant when I said before that your income also affects your health care. It affects your income taxes, but it also affects your health care costs because of things like IRMA, which is a surcharge that they're going to levy on your Part B and or D premium as your income increases. Okay. Also, your Social Security does become taxable if your income exceeds $34,000. So that's why we say it's tax preferred. It is not tax free. It's tax free as long as you are below, your total income is below that threshold. But as soon as your income exceeds that $34,000 threshold, which you all know is very easy to do, again, retirees, you got pension, you got Social Security, you got rental property income, you got maybe you pulling money out of your 401k. So having 3, 4, 5 different income streams, chances are you're not, you know you're going to have to pay taxes on Social Security. So that's an additional amount that you're going to have to give to the federal government. Without proactive tax planning, you're going to give more to the federal government than you would otherwise give. Also, there's something known as the net investment income tax. Now, this is a tax that is applied to capital gains. So this is, for example, you have the 0%, 15%, and 20% tax brackets for capital gains. Now, those are going to go up again, just like with income taxes. Those are going to increase after the Trump tax cuts expire December of 2025. But as of now, if you sell, say, for example, let's say you have rental property, we talk about the net investment income tax. You sell that rental property, okay, you're going to have to pay capital gains taxes. Now, the capital gains tax rates are lower than ordinary income tax rates. But if your income exceeds total income, as a single person exceeds $200,000 or $250,000 as a married couple, they're going to charge you an additional 3.8% on top of the standard capital gains tax rate. So you're going to pay another 4% on in taxes when you sell that rental property, or if you have stock, for example, that you've held for a long period of time. Maybe you somebody in your family gifted you some stock. Maybe you got some Coca-Cola stock, whatever, Walmart stock. You never sold it. It's increased in value. When you get ready to sell that stock and your income exceeds these numbers, you're going to pay an additional 3.8% on top of the standard capital gains tax rate. So if you're at a 20% capital gains tax rate, which is the top capital gains tax rate as of the date of this recording, you sell your rental property, whatever your profit is after your basis has been taken out, whatever your profit is, you're going to pay 20% plus another 3.8. So you're basically going to pay about 25% of that to the federal government. And that's not counting your state, because remember, your state also assesses taxes as well. So we're just talking about at the federal level. Okay, so you see how this thing can get real, it can get real murky when you start talking about multiple income sources, rental property. You start to pay a lot in taxes and you realize, oh my goodness, I don't have as much money as I thought I had. Also, thing you want to think about is what's called the ACA penalty and disqualification. Now, this has to do with something I'm going to talk to y'all about here in the next slide or two. If you are on an Obamacare plan and you qualified for a subsidy, so you went out into the Obamacare market and you applied for insurance plan, you signed up for that, you're paying that, and you met the qualifications to receive a subsidy, once your income exceeds a certain amount, you could lose that subsidy, which means that your premiums will increase, your out-of-pocket costs will increase for your health insurance. Now, this is really more specifically for those of you who retire before the age of, before your Medicare eligibility age. You don't get Medicare till 65, but if you retire at 60, either you're going to have to you're going to have to go out and buy your own health insurance, or you're going to have to, you can continue to use your insurance, your health insurance from your job, or which is the last option, which is probably what you should do because it's more affordable. You go out into the healthcare market, go out, submit for the subsidy, you get approved, everything's good to go. But keep in mind, just like with Medicaid, okay, any government subsidies that you receive, anytime the government's paying for something, they don't want you to have anything. They don't want you to make any money. They don't. So when your income exceeds a certain amount, you might find out, you might get a little letter in the mail, oh, your subsidy goes away. So now guess what? Now you're paying more for your health insurance premiums. Even if you don't go to the doctor, you're going to have to pay for those premiums. So again, these are all examples of stealth taxes. These are sort of landmines you want to kind of know about before you get to retirement so that you can avoid them, or at really probably the more realistic scenario, realistic case, is you minimize the impact of these stealth taxes. And you can do that very easily by just planning your moves, right? Don't just retire and say, oh, I'm going to take the pension and then I'm going to take my Social Security at 62. Well, then guess what? How is that going to impact your Medicare? How is that going to impact your other taxes? Are you going to now be bumped into a different tax bracket where you have to pay for other surcharges, okay, or other taxes based on the fact that your income exceeds certain thresholds? So now let's kind of do a deeper dive into the IRMA, okay, the Medicare IRMA tax, which is a surcharge that is levied on individuals whose incomes exceed the numbers that you see on the screen. On the screen here, I have the IRMA cost as of 2023 for both a single and a couple filing jointly on their tax return. The first row that you see here is for a single person making $97,000 or less. The number you want to look at here is out to the far right under the total annual cost This is the total cost that someone who is making under $97,000 a year. This is how much they are paying, okay, for both their Part B premium, because your Part B is going to be when you receive your Social Security check and you enroll in Medicare, okay, they're going to start taking that Part B premium out. That Part B premium as of 2023 is $164.90. That's a $1,900, call it $2,000 a year. Your Part B premium is what you pay for your prescription drug coverage. That's $33 a month. And you see the annual cost here of $396 per year. If you add the $396 annual Part D drug cost plus the $1978, you get the $2374. So this is the premium that you're paying for Medicare. This is what the federal government is charging you for your Medicare. Okay, they take that out of your Medicare, out of your Social Security check every year. But notice, as your income increases, so does the amount that they take out of your Social Security check. And you see here that it goes from 2,300 to 3,300. You see $1,000 jump in your cost, your annual cost, when you make between $97,000 and $123,000. You got a couple making $200,000, which is very easy to do, by the way, especially if you retired from the federal government, you got a pension, you got Social Security, you got investment property, you got all these income sources. You got a two-income household of two federal government retirees. Your income could very well easily be $300,000, $400,000, $500,000. So if you're looking at a income of $300,000 a year, your Medicare cost is $8,000 a year. Okay, we're talking about serious money here. And again, this is a surcharge that is levied on your Medicare Part B and D premium. Okay, so again, we want to make sure that we're planning for this, and the way we do that is by proactively engaging in tax planning, okay, so as to minimize the effect of these surcharges on our take-home income. And that might be as simple as just maybe looking at like where your money is going today, right? We talked about the four buckets earlier, right? The tax-free, the tax-preferred, the tax-deferred, and the taxable. Well, you might want to start looking at maybe doing some Roth conversions, moving some of your money out of those taxable accounts or the tax deferred accounts in the tax free accounts, right? Just making some of those changes now can minimize the future impact of things like IRMAA on your healthcare costs, okay? And as I already said to y'all before, you retire before the age of 65, you're going to need to have your healthcare coverage elsewhere other than Medicare, because Medicare is only effective as of 65. So if you retire at 60, you're going to have a coverage gap, a health coverage gap between 60 and 65. The recommendation is for you to go out into the ACA marketplace, submit for a policy there. You usually will qualify for a subsidy based on your income, and that will usually make those plans more affordable than if you were to maintain, for example, the coverage that you currently have through your job, and definitely more affordable than what you would pay if you were to go out and acquire a private health insurance plan. So the ACA is just a way. Now, the thing about ACA, okay, this is another thing, and some of you already know this, it is not it's not going to be a permanent fix. If you're 60, ACA is just meant to be a temporary fix, okay? ACA can get really pricey in future years. So it's just a temporary fix, okay, until you hit 65, and you can actually then take advantage of the Medicare, okay? So again, prior to 65, ACA Marketplace provides you the opportunity to get a subsidy to reduce your out-of-pocket costs for your health care. Okay. Now, again, while we're on the topic of healthcare, one of the things I did, everybody, was when I started my company a little over 10 years ago, actually about 12 years ago. One of the things I did was a lot of work with individuals that were needing assistance, financial assistance with their prescription drug costs and the other out of pocket costs associated with their health care. So one of the areas of I have a lot of experience in is this conversation or this topic of the relationship between one's income and their healthcare costs. Now, I've already told you all that if you are a retiree, okay, a pre-retiree, you're looking forward to retirement, you're trying to get your ducks in a row, you can always just maintain the current healthcare plan that you have right now with your job. Now it's going to be significantly more expensive because when you're at your job, the reason why it's less expensive is the employer is bearing some of that cost for you. When you leave that job, you're no longer being subsidized by that employer. So so when you if you choose to keep your current health plan, just know it will get expensive, which is why, again, I recommend you going out to the ACA marketplace. Now, the thing with this, remember that you got to make sure that you're timing this thing correctly, because making a move at the wrong time could mean that you could end up losing your subsidy. Okay. And then that means all of your out of pocket costs for your health care will be more expensive. Another thing you could do with proactive, this again is about being proactive with your tax planning. If you're someone who has some assets, but not a lot of assets, and you basically want, or you're at that sort of threshold where you can qualify for Medicaid, you can look at utilizing certain financial planning tools to make it easier for you to qualify for Medicaid. That way, your 401k or your IRA or your real estate doesn't necessarily count against you. Those assets can be excluded from from the qualification criteria by using something called a Medicaid Asset Protection Trust. Now, a lot of you watching this won't really apply to you, but it is an opportunity for those of you who do have significant assets and you are concerned about health care. Maybe you have some health issues going on. In order for you to obtain Medicaid, Medicaid basically requires you to have pretty much nothing, right? $2,000, right, in assets. Well, I mean, you don't even have to really do much anything to accumulate $2,000 assets, but nevertheless, you need to have no more than that, or else you will not qualify for Medicaid. So again, this again goes back to being proactive with your tax planning. Also, Medicare Savings Program is a program that is also income based. Remember, we're talking a lot about income taxes on your retirement income, but we also now layering in the relationship between your income and your healthcare costs. And one area that you want to think about is when you go into retirement and you're starting to pull your Social Security and you have your Part B premium. Remember, we said before, your Part B premium, if we go back to the IRMAA table, your Part B premium, if you do not have an IRMAA surcharge, if you make less than $97,000 a year as a single person, your Part B premium is $164 a month, unless you qualify for the Medicare Savings Program, which is a state administered program that you can apply for. You can actually go to I believe you go to the Social Security website, on the Medicare.gov website, you can apply for the extra help and they will actually pay your Part B premium for you. Okay, so this is a way where if you are, maybe you're not in the category of maybe having a lot of assets, but you are maybe at an income level where you do qualify for some additional subsidies, so you can go out and apply for what's called a Medicare Savings Program, and that will waive the $164.90 that you're going to have to pay for your Part B premium. So again, this is about helping you keep more of your money in retirement. Okay. Also, the extra help program is also available. Okay, because this has to do with prescription drug costs. So there's a subsidy that will actually pay for your Part D as well, cover your basically out of your out of pocket costs associated with your prescription drugs. You know, in our community, a lot of black folks are diabetic, have high blood pressure. You got to still take those medications when you get into retirement. Okay, and one of your biggest expenses in retirement is what? Your health care. So anything that we can do, okay, on the front end, be it tax planning or making sure that we can take advantage of some of these subsidy programs like Medicare Savings Program or the Extra Help Program or going out into the ACA marketplace and qualifying for an income-based subsidy there to reduce your out-of-pocket costs. All of that stuff is going to help you keep more of your money in retirement, okay? Now, let's talk about the widow tax. Now, this is really something that you probably already intuitively know. What happens if let's say you're married, okay? Now, a lot of you all are married, some of you are not. I have on the screen here two examples, one for a married couple, another one for a single person. When you are married, in most cases, let's talk about the widow tax, okay? This is an additional tax that you're going to have to pay if your spouse passes away. Now, it's not really an income tax. It just basically is you having to pay more in income taxes than you were paying while your spouse was living. Now, what do I mean by that? Here's what I mean. If you are a retiree, and now this is another thing, think about this. If you're in your 50s, in your 60s, you're married, chances are you're going to be filing your taxes as what? Married filing jointly. That's how you're going to file your taxes. Okay. Now look at this example here in 2021. Let's say, for example, you filed your income taxes married filing jointly. And let's say you receive an interest. And remember, we talked about all these different streams of income. You're getting dividends, right? You getting interest. Maybe you have a CD, right, that's paying 5%. You maybe have some stock that's paying you dividends. Or maybe you have investment property, you receiving rental income there. You're taking money out of your retirement account, right? You got a pension. And then you have Social Security. So you got all of these income sources totaling up to $144,478. Now, remember, you are married filing jointly. Okay, so you have a what? Larger standard deduction because you're married filing jointly. So you take the standard deduction away from your income, and that leaves you with a taxable income of $116,000, which means your tax on your total income is going to be $17,168 in the year that you filed married filing jointly. But let's say, for example, in the next tax year, okay, let's say your significant other passes away. Well, guess what's going to happen? Your interest income is probably not going to change. Your rental income is probably not going to change. But what will change is what? Your Social Security is going to change, right? Because if you are married and you're both receiving Social Security and one of the person passes away, the surviving spouse will not get both Social Security checks. You'll only get the higher of the two. So what that means is you have lost income. So that's strike one. Okay. The second strike is you have to now file single because they're no longer here. You could file married filing jointly for the tax year that they pass, right? But if they pass in that year, the following year you can't file married filing jointly anymore. You got to now file at the single rate. So guess what? Now you have a what? A lower standard deduction, okay? And your tax rate as a single person is going to be higher than it would be if you were filing married filing jointly. So guess what? When you run all the numbers, we have less income, we have less of a standard deduction against that income when we file our taxes, we have less taxable income, but we actually pay more in taxes. You see that? So we actually have less income, less taxable income, but because we now are having to change our tax status from joint to single, we have less of a standard deduction and we have a slightly less income on the Social Security side. We're now paying $20,000 in taxes. You say, well, Jerry, that's not that much. Well, actually, it is, everybody. From 17,000 to 20,000 is almost a 20% increase in your tax bill. So when your spouse dies, your taxes will increase. Okay? So this is something you want to think about when you're 55, when you're 60. Okay? You getting older, we're not going to be here forever. We all are going to leave here, right? So what you also want to think about is the longevity, right? Your mortality. When somebody passes away, if you go before your husband or your husband go, it don't matter who goes before who. Somebody's going to pay, that tax bill is going to go up. This also ties into what? Making sure you have sufficient life insurance coverage, right? Because if nothing else changes, your tax bill will increase because you have what? Less income, and you're having to file at a single rate versus filing at a joint rate when that person was here. So again, I know this is, the light bulb should be going off. This is not something you think about until you're in the thick of it. And that's why it's important for you to engage in proactive tax planning. Okay. Now, this is another area that you all want to think about as well. Inheritances, okay? When you get older, as you get older, it can happen when you're younger, it can happen at any age, but you get older, sister may pass away, brother may pass away, cousin may pass away. You may have an older parent, auntie, uncle that passes away, and they leave you. Well, God forbid you have a kid that passes away. That's terrible. I mean, everybody would say they would rather go before their kids, but look, you don't know. Anything can happen. But here's the deal. You're going to be left money. There's going to be a good likelihood that as you get older, you're going to get money left to you. And that money is usually going to be in one of three categories. It's going to either be an inherited retirement account, right? Somebody passes away, they leave you with their IRA account. Now, that is now a part of what? Your assets, and that has to be factored in to things like required minimum distribution amounts. There's a 10-year rule if they're a non-spouse versus spouse. I'm going to make another separate video about inherited IRAs, but for the purpose of this video, the thing you want to also think about as you get older is the possibility. You can't predict it, but you can kind of think about it and plan for it. When you receive money from a retirement account, you inherit a retirement account. How is that going to impact your income tax situation? How is that going to impact maybe your ability to qualify for certain state benefit programs that you now might be eligible for example? But let's say somebody passes and you get $200,000 of life insurance proceeds where you are currently on a fixed income. Maybe you don't have a lot of money in your IRA. Maybe you don't have an IRA at all. Maybe you don't have a 401k, but you got maybe a little bit of a pension, maybe Social Security. That might be all that you're getting. Maybe you're able to qualify for extra help, which is what I showed you on the last slide, or you qualify for the Medicare Savings Program that pays your Part B premium. You qualify for this stuff, but guess what? You get $100,000 life insurance check. Guess what? Now all of a sudden you don't qualify for that stuff anymore. How are you going to plan for receiving unexpected windfalls? And this again is why it's important for you to sit down with a financial planner that can help you see these things before they happen. The job of a skilled financial planner is to jog your thought process, to help you think about these things before they happen so that they don't catch you off guard. You getting a big chunk of money. Now all of a sudden it affects your healthcare costs. You now got to pay more in taxes, and it affects all of these other areas where if you had sat down and engaged in proactive tax planning, you could have set up maybe a revocable or irrevocable trust to receive the life insurance proceeds. That way, what? Now those assets are not counted as a part of what? Your asset. You see, these are things, these are planning tools that we can do, planning tools that we can implement. You might be receiving real estate. Somebody passes away, they leave you property. Is it a rental property? Is it a primary residence? How is that going to impact your financial condition? How is that going to impact your taxes? How is that going to impact your healthcare costs? How is that going to impact your ability to qualify for certain programs that you now might qualify for, but as a result of receiving these assets, you now may not qualify for them? Again, sometimes there's only so much we can do because you can't plan for everything. The point is not to try to plan for everything. The point is to put you in a position where you have a conversation, you have a thought process that allows you to see broader and further ahead than you currently are looking right now. Okay? So again, these are things you want to think about as you're going into retirement. These can also impact your income tax situation. Now, most people, when they go to claim their Social Security, most retirees claim their Social Security at 62. Most people do not wait until 70. Now, I'm not saying that, and that's not to say that that's the best thing. I'm telling you what most people do. Most people, and you see it on the screen here, about a third of retirees take their Social Security at 62. And there's a number of reasons for that. A lot of people maybe don't have the savings, so they need to take they need to take it as soon as they can get it. Some people, they're afraid that Social Security may not be there, so they're trying to get as much out of it as they can while they can. Right? You getting older, you know you don't have that much longer to live. You ain't gonna live, you 60, you ain't gonna live another 60 years probably, right? So you trying to get your money while you can. You've paid into it, you want to take it out. But the thing you want to think about when you're talking about claiming your Social Security early, okay, specifically, we're talking about claiming it before your full retirement age. Now, what I mean by full retirement age is the age at which you receive 100% of your Social Security benefit. For most of you, that's going to be 66. Now, it's not going to be exact, okay? It depends on your birthday, but for most people, okay, it's around 66, 66, 67, depending on your birthday. So if you take your Social Security benefit at 62, so this is what I'm trying to get at here. Most people take it at 62. The question is that the best time to take it? Now, if you're looking at this solely from a numbers perspective, right? If you just looking at it like, okay, what's going to give me the most benefit? Well, clearly you can see on the screen that the best time to take your Social Security benefit is at the age of 66 or older, because at the age of 66, you get 100%, and then they increase your benefit by 8% every year you wait. So in other words, 66 is 100% of your full retirement benefit. If you wait instead until 70, you're going to get 30% more Social Security per month than you would had you taken it at 66. Now, here's the other thing you want to think about. Now, we know that you're going to get more if you take it later, but what about when you take it earlier? What are some of the other landmines that you want to think about? Now, I didn't really put this on the screen, but I'm sure you all are going to follow along with what I'm saying. First thing you want to think about is what I have at the bottom of the screen. If you claim your Social Security, your Social Security benefit before 66, before your full retirement age, and you are still working, you choose to go to work, Social Security will stop they will stop paying you if your income exceeds a certain amount. I didn't put I don't know. I guess I must have had a brain fart when I typed this. But if your income exceeds a certain amount and you take the early benefit at 62 and you decide to go to work, they're not going to pay you the full Social Security. They're not going to pay you your Social Security and then they also let you get a paycheck. If your paycheck exceeds a certain amount, they will stop your Social Security benefit. So that's the drawback to taking it early. Is you're going to be limited in how much income you can earn, right? Because think about it, the government doesn't want you to take Social Security early. They want you to wait to take it. So if you take it early, they're going to penalize you anytime you make money above a certain amount. I believe the number is like $1,000 or something like that. So if you go and you make $1,000, let's say your Social Security benefit is let's say the maximum benefit is $1,000 a month. You go to work and you make 2,000. Well, let's say you make 1,000. Well, if you make 1,000, they're not going to continue to pay you the $1,000 Social Security benefit while you make 1,000 a month. They're going to basically reduce the benefit by whatever it is you make. So basically, they're going to stop the whole $1,000 altogether. Now, that's important to note because when you're taking Social Security early and you're delaying things like your IRA, most of my clients will take their Social Security at 62 or 63, right? You'll take it here and you might have an IRA account with 500,000 or $1 million in it. And what's going to happen is you're going to take Social Security, Social Security, Social Security, or maybe you take it at 66. You don't mess with your retirement. You don't mess with your 401k. Just let it go, let it go. Well, what's going to happen when you get to 72? Now you got a retirement account that might be double. You done doubled your retirement account. So guess what? Now you got another tax problem. Now you got to get all that money out of the retirement account because you have what's called required minimum distributions. So now you got to pull that money, and that's going to put you in a whole nother tax bracket. You see what I'm saying? So that's why we have to really be strategic about when we take Social Security, when we draw money out of our pre-tax retirement plans, so that it does not create a tax problem for us later. By you taking your Social Security early, it could potentially be creating a tax problem for you later that you may not be able to get out of because, again, that retirement account, they're going to make you take that required minimum distribution once you hit 72. Okay. Now, this is just kind of showing you all about the taxation of Social Security and the income levels at which Social Security is taxed. Now, this, just so you know, they're just saying here that this is the percentage of Social Security that is taxed. This is not the actual tax rate. This is the portion of Social Security that is taxed. So, for example, if you make $100,000 a year, which puts you down at this third level here, then they're saying, let's say if your Social Security benefit is 2,000 a month, okay, then what they're saying is that you're going to pay $1,700. You basically $1,700 of that 2,000 is going to be subject to tax because 85% of 2,000 is $1,700, right? So what they're saying is 85% of whatever the benefit is, okay, will be subject to income tax. Okay, so again, income tax, this is why we talk about Social Security being tax preferred and not tax free, all depending upon whatever your income level is. All right, everybody, so we are about to be wrapping up. But before we wrap up, I'm going to end with the thing that you're all probably asking. Okay, Jerry, so how do I reduce my income taxes? Can you just essentially lower your overall tax bill? So this is really a presentation for those of you who, if you're watching this, you probably have a tax problem. You probably have some money. Okay. If you ain't got no money, this ain't a presentation for you. So if you're watching this is about helping you keep more of what you earn, more of what you save. So now I'm going to give you the keys to the kingdom. How are we going to help you reduce or possibly eliminate some of these taxes that you're going to be paying in retirement, specifically as it relates to capital gains taxes, ordinary income taxes, and potentially taxes on your Social Security. Okay. So, first thing is, remember we talked about having those four buckets, right? I really want to go back to that slide. I'm going to do something I don't normally do. I'm going to come out of this and I'm going to go back to the first slide that we started with. You all remember I said that we have four categories of money, right? We got four buckets. So if you have retirement money, it's going to be in one of these four categories, okay? What you want to think about is moving your money, as much of your money as possible, okay, from tax deferred into tax free accounts, or from taxable accounts into tax free accounts. You move your tax deferred into tax free, basically just doing a Roth conversion. Okay, you got money right now in your 401k. Let's say you're 60, you got a 401k, you got that money, you know you're going to get a certain amount for Social Security, you got investment property, you got all this money out there. Okay, I've already showed you that the Trump tax cuts are going to be over with by the end of 2025. So you already know that if you don't do anything at all and you leave all this money that you got saved in this tax deferred account, you're going to pay more taxes on every dollar that you pull out of that account. So what you want to do now, especially if you're like 55, 60, anytime before you get to your full retirement age of 66, you want to try to convert as much money out of your pre-tax retirement accounts into Roth as possible. Okay? You want to convert as much of that money as possible, because if you leave it there, you don't do anything, you're going to end up paying more in taxes. Now, here's another thing that people ask is, okay, they know they should probably convert, but then the next question is, well, Jerry, when is the best time to convert? Well, the best time to convert your Roth IRA is, number one, when you anticipate being in a higher tax bracket in the future. If you're watching this right now and you think that you're going to be in a higher tax bracket in the future, which we already kind of talked through, the fact that some of you got multiple streams of income, you got rental properties, you got pension, you got you got all this money coming to you. Maybe all of that money's not coming to you now because you're not fully retired. Maybe you retire at 60. At 60, you're not getting your Social Security. Okay, you may not be getting a pension. Okay, or you might be getting a pension. Okay, but you might just only be pulling money from your pension and maybe from your investment property. Guess what? When you hit 60, when you get to 62 and you decide to take your Social Security benefit, well, guess what? That's another income stream that's going to potentially put you in what? A higher tax bracket. So what you want to look at doing is taking your pre-tax money, converting that money into Roth money. Again, if you anticipate being in a higher tax bracket, meaning if you think you're going to have more income in the future, it's going to put you in a higher tax bracket, or if you think that tax rates are going to increase, which I've already shown you that they will, you want to look at converting your Roth, your traditional or your pre-tax money into Roth money. Another thing to think about when doing your Roth conversions is when you convert your Roth, or how much of your Roth you convert determines how much you're going to pay in tax. Remember, when you do a Roth conversion, basically you're more or less moving that money out of a pre-tax environment into a tax-free environment. In order to do that, you got to pay the piper. Uncle Sam requires you to pay the tax in the year that you do the Roth conversion. However, you can control how much tax you pay by when you do the Roth conversion and how much you convert. You do not have to convert it all at once. Now, to kind of highlight what I mean by that, remember these are the current tax brackets. So let's say, for example, you are single, okay? And matter of fact, let's say you're married filing jointly, okay? You're married filing jointly. You and your husband have rental property. You have rental property. You both get Social Security. You both get pension, okay? You got all this money in your IRA account with Fidelity, or you got a big chunk of money in your TSP. You want to get that money out of there into a tax-free environment, but you're like, well, damn, I got $500,000. How am I going to get that much money out of the account without taxes eating me alive? Because if you take all that money out at once, you're going to pay taxes on the full amount. That means that if you have $500,000 in your TSP and you already are making 150, that means you got to your income that year is going to be $650,000. Where if you do that Roth conversion in 5 years, when the Trump tax cuts will be done with, you're going to be paying 40 cents on the dollar on any income over $480,000. So would you rather do that then in 5 years when the Trump tax cuts are over? Would you rather go ahead and take your vodka right now, take it right now, take your spanking right now, because you wait till later to take your spanking, you're going to end up paying much more in taxes. Okay. Now, if you don't want to take it all at once, you can actually do partial conversion. So if you're already, say, at $156,000 a year, and you don't want the money that you're taking out of the traditional account to push you into a new tax bracket, what you can do is just look at the difference between 156, let's call it 156 and 237. Take out just enough where you don't actually go into the next tax bracket. Now I'm actually doing this math right now for 237 from 156. That is $81,000. So if you wanted to take $81,000 out of your traditional IRA, convert that into Roth, you can take $81,000, and if you have $500,000 in that account, basically after 6 years, you basically have moved all that money out of the account, and you have not actually increased your tax bracket. You're still at the 28% tax bracket. So how much you take out, you don't have to convert it all at once. I recommend converting a little bit of it at a time so as to not move yourself into the next tax bracket, which is going to be meaning that you're going to pay more in tax on every dollar that you convert out of the traditional pre-tax account into the Roth account. Another thing you can do is take advantage of life insurance. Leverage the cash value life insurance contracts for their tax efficiencies. You're able to put a lot of money into life insurance and take that money out in later years tax free. My company sets up a lot of these plans for Black retirees all over the United States. That is exactly what we do. So besides doing the Roth conversion, you can also take any after tax dollars you have right now. You got money sitting in your savings account. You're not doing anything with it. It's in a taxable account right now, right? You're not doing anything with it. You're paying taxes on it every time you get an interest payment. You're paying taxes on it. You get dividend distribution. You're paying taxes on it. Why not take that money out of a taxable environment and move it into what? A tax-free environment. You can do that by simply moving it out of where it is now into an insurance contract. Again, to do that in most cases, you're going to have to pay the tax depending on where the money's coming from. But you pay taxes one time to get it in there, and you never have to pay taxes again. Again, this is all about helping you keep more of your income in retirement, helping you reduce your total taxable income in retirement. Okay. Also, you want to maximize your Social Security benefits over other sources of income, because Social Security, remember, is tax preferred. Okay. Now, you always want to make sure that you are examining or kind of reviewing your income needs, because every situation is going to be different. But what I do want to show you is on this next slide here, the difference when you're taking Social Security. Let's say you need $90,000 of income, which is $7,500 a month. Again, This is about helping you maximize your Social Security benefit income. Because if you need $90,000 a year to pay your bills, right? You need $90,000 a year to maintain your lifestyle. Well, you got a couple of ways to get that $90,000, right? You can take it from Social Security, some of it from Social Security, some of it from your IRA account. But look what happens if you take the $90,000 from completely from your IRA. Look at how much you're paying in taxes versus if you took some of it from Social Security and some of it from your IRA. It's still the same $7,500, but look, you actually have reduced the amount of taxes you're paying. Why? Because Social Security is a tax preferred, okay, income source. You don't pay taxes on the full amount, even if you make more than what you should be making, meaning you make over the threshold where it now becomes taxable. Even if it becomes taxable, you're still never going to pay taxes on 100% of your Social Security. So it's best if you try to really delay your Social Security as much as you can, at least in the near term, until it gets to the full retirement benefit. That way, when you get to 66, you got a higher benefit that is not going to be taxed at the same rate as it would be taxed if you basically took it all early. Because guess what? If you take most of your money as Social Security, and which is really not, but this is assuming like a two-income household. But if you're in a two-income household, you're taking this out. Well, guess what? If you're taking most of it as Social Security, well, guess what? Now your tax bill has went down. So what we want to make sure we're doing is we're pulling money from the buckets that's going to help us maintain our lifestyle, but also not increase our tax bill. And the biggest opportunity is with your Social Security benefits. And I do recommend maximizing that benefit. Pull money out of your IRA right now. If you're going to retire at 60, start to pull money out of your IRA now. Don't wait till 72, because guess what? Pulling the money out now, you're going to be at a lower tax bracket in most cases. Because remember, the Trump tax cuts are going to go away. So you're taking it basically out of the IRA right now, going ahead paying the taxes. That way, when you get to 72, you don't have to worry about there being this huge IRA balance or this huge 401k balance. Now you got to take required minimum distributions, and then that's going to be on top of your Social Security, on top of your rental income. So now you're basically going to be at the extremely high tax rate, okay, in your 70s. And that's the time when you don't need to be worried about paying so much in taxes. But you're going to be probably in a higher tax bracket then than you might be at 62, because again, you let that IRA sit there, you let that 401k sit there, and you really did not take advantage of maximizing your Social Security benefits by going ahead and taking that money out of the IRA early, taking it out of the 401k early, drawing it out so that you don't have a bigger balance to deal with later on in retirement. Okay, so that's a way that's going to help you to reduce your overall tax bill, is by delaying your Social Security as much as you can, pulling it out of your 401k, your IRA, your TSP for the years that you are waiting on your Social Security to hit, and then you switch to your Social Security, and it ends up saving you a lot in the long run, a lot in taxes. Okay. Also, if you have real estate property, right? You know, a lot of my clients are real estate investors. So you might have property that you are selling. Maybe you've owned a duplex or an apartment building, and you decided to sell that property. Guess what? You got to pay capital gains tax. Well, you know, you're at 65, 66 years old, you're getting a big chunk of money from an apartment building. You may have owned that thing for 10 years. You may not even have a mortgage on. So guess what? You sell it and you might get $300,000. Well, guess what? Now you're in a whole nother tax bracket. So another thing you can look at doing is you can look at doing what's called a 1031 exchange if you're a real estate investor, and just take the money from that sale the proceeds from that you've netted from the sale of that particular real estate asset, and invest it into another vehicle. That way the income doesn't get recognized, and you can continue to draw a rental income from the next asset that you acquire from those proceeds. You can also do what's called a deferred sales trust or a charitable remainder trust. These are some more advanced strategies to help you eliminate or reduce your capital gains tax that you are going to create as a result of selling a long-term asset. Okay, so again, we can use a couple of things to, depending on the asset, to actually reduce or eliminate the capital gains. And again, that's going to flow down to your tax return, because now you sell that property, that money, that income, that those proceeds do not get reported on your income taxes, which again means you don't have to worry about it putting you in a new tax bracket. You don't have to worry about it affecting your Medicare. You don't have to worry about it affecting even any of the other government programs from which you might be receiving benefits at this point. Okay. Also, this is a big one. You want to maximize depreciation during your working years. Now, most of you, the easiest way for you to get depreciation is for you to buy real estate, buy a property, put a tenant in there, and you get to write off, okay, the a portion of the purchase price every year, okay. And depending on if it's residential, it's 27 and a half years for residential, 39 years for a commercial property. But let's say you buy that property, you can do things like accelerated depreciation. There's bonus depreciation that you can take right now, which will be expiring. I also think that expires in 2025 as well. So you can actually have additional depreciation. What that depreciation does is it helps you shelter any like 1099 income or in rental property income, any income sources, okay, any W-2 income that you might be receiving. It helps you to shelter that money during your working years, so that money you can now start to reinvest that money into more tax advantage vehicles, such as life insurance, such as more real estate, so that when you do get out to 66 or 70, you've taken advantage of that depreciation to lower your current taxable income. And guess what? By lowering your current taxable income, that tax savings can now be put into investments that will pay you a retirement income in the future that will be at a lower rate. You understand that? So it's about really, this is about being proactive during your working years now before you retire, so that we can create this depreciation, create this income, and now you have a lot more flexibility, a lot more, liberty in terms of where you're going to be pulling retirement income and to what extent that income is going to impact your income taxes. Okay. All right. I am done for today. I would like to thank you all. This presentation was much longer than I anticipated, but I do appreciate you all for staying on to the end. If you stayed on to the end, okay, this was something that resonated with your spirit. You want to go further down the rabbit hole. You want to attend one of my in-person workshops. So there's a couple of ways that you can get in touch with me. Okay. You can attend either my online or in-person workshop. Now, depending on where you're seeing this, okay, there will be a link that is next to this video that's going to allow you to register to attend the either in-person or virtual event. So if you want to attend my in-person or virtual event, I'm going to go into a lot more detail. We're going to be talking about life insurance, structuring life insurance, helping our Black retirees take advantage of some of the newer strategies, more advanced strategies to help them keep more of what they earn, okay, to maximize what they have, okay. This is all about helping Black retirees and pre-retirees, Black people in this country, build wealth, keep their wealth, transfer their wealth, okay. So again, if you're interested in this is sort of I guess you can call it a primer. But if you're interested in learning more, we're going to go into a lot more detail in the workshop. We're going to cover some investment strategies around life insurance, some other things around estate planning that are going to be extremely important for you if you're looking to position yourself for future financial success. It's all about preparation and planning. And the way you engage in preparation and planning is by what? Educating yourself. So again, if you're interested in attending an in-person or virtual event, you can click somewhere around this video. There will be a link. You can also schedule a consultation. So if you are a person who has some money, you may be looking to do a Roth conversion, or you looking to set up some investment accounts, you're looking to set up some things, move some things around, and you want some guidance on how that's going to impact. That's what we do at the Black Wealth Company. Black Wealth is our business. And part of creating wealth, we got to also show you how to keep what you've already saved. Everybody talks about making money, making money, making money. But guess what? You make all this money, but you don't have the proper things in place to keep what you've already made. You're just talking to yourself. You're talking into the wind. So what we're going to do in your consultation, get to know you a little bit better, figure out what you have, provide, get some numbers from you, provide a recommendation, and present a plan to you that's going to give you a high probability of future financial success with respect to not only growing your money, but also helping you keep the money that you're going to make. Okay. And then you can also call my office. Okay. If you're old school, and you just want to call my office and schedule a consultation, we basically, I have an assistant that will answer, that will get you scheduled for a consultation. If you call, you'll have an opportunity to leave a voicemail, and somebody on my team will get back to you, give you the opportunity to set up an appointment. If you have some maybe questions before you set up your appointment, you can ask those questions when we return your call or when we answer the call. But again, everybody, thank you so very much for attending this presentation. Again, to register for an upcoming workshop, you can click somewhere around this video. You also will have a link to schedule your appointment, www.blackwealth.es.me. You'll also see a link to my website, and you also have my number there at the bottom to give us a call, and we will take very good care of you. We're Better Business Bureau accredited with 0 customer complaints. I pride myself in serving my community to the fullest. I love you all very, very much. Peace and blessings to you. Thank you again for attending today's workshop. I am Jerry Gordon, President and CEO of the Black Wealth Company, where Black Wealth is our business.